The first half of 2026 just closed, and it closed at record highs. The Dow, the S&P, and the Nasdaq all finished the half at fresh records. On paper, a triumphant 6 months. But here's the tension we want to sit with today. It was one of the narrowest record highs you'll ever see. A tiny handful of chip stocks did almost all the lifting, while most of the rest of the market quietly went the other way.
So the picture is genuinely split screen. On one side, a real, validated demand story in AI and memory. On the other, a thin, rate-hawkish month-end tape, and a holiday-shortened week ahead where a single jobs report on Thursday is, more or less, the whole ballgame. Let's take it apart. Disclaimer first. First, a quick and honest word. Everything you're about to hear is really just the two of us thinking out loud. Personal market commentary, made for learning and for fun. It isn't investment advice, and it isn't a recommendation.
And when we talk about a specific company, it's only ever to make a bigger idea click, never a nudge to buy or to sell. So take it as a starting point for your own curiosity. Do your own research and make the call that's right for you.
Quick and clear. This is education and entertainment only, not investment advice. Everything we mention, indexes, stocks, commodities, is a public example to talk through what happened, never a recommendation. No buy or sell calls, no price targets. We're here to test our theses against the day's evidence, not to tell you what to do. Verify everything yourself and do your own research.
The closing numbers. The Dow finished at 52,319, up about 0.25%, a record. The S&P 500 at 74.99, up 0.75%, a record. And the Nasdaq at 26,213, up just over 1.5%, chip-led.
And the tell was the semiconductor index, the SOX, up nearly 4% on the day to around 14,200. When the chip index is up 4% and the broad market is up under 1, you already know the shape of the day before you look at anything else. This was a semiconductor melt-up that happened to drag the indices to records with it. Step back to the whole half, because the numbers are striking. The Dow up about 9%, the S&P up 9.5%, the Nasdaq up 12%. And then the semiconductor index up somewhere between 93 and 101%. The second quarter alone was up around 88%, its best quarter since 2020.
And the engine underneath it was memory. The numbers are almost hard to say with a straight face. One big memory maker up roughly 300% year to date, its market cap crossing $1 trillion. Another memory and storage name up something like 785%. A long struggling chip giant up 260. Whatever else is true, the market spent the first half deciding that memory was the scarce thing and repriced it accordingly. And it wasn't just the memory makers, it was the companies that equipped them. The equipment and tool names lit up again. The big process control name up more than 8%, the lithography leader up almost 6%, the etch leader up 5.5%, the broad equipment giant up 4%. Plus the AI accelerator names, one up nearly 8%, another up over 7%.
This is the thread we keep pulling in this show. Follow the money to whoever enables the expansion. If the world has decided it must build more memory and more AI silicon, then the picks and shovels, the folks selling the tools to build it, get paid regardless of which chip maker ultimately wins. And today, once again, that's exactly where the money went. It's becoming one of the most durable patterns of the year. Now the other half of the split screen, and it matters. Underneath those records, market breadth was poor. On the S&P, more stocks fell than rose, roughly 213 advancers against 290 decliners. So the index went up, while the typical stock in it went down. That's the definition of a narrow rally.
And it wasn't random which stocks got sold. The rate-sensitive corners, real estate, utilities, consumer staples, the classic defensive and bond proxy groups were actively dumped, each down well over 1%. So this wasn't a broad, healthy, everyone's invited rally. It was a concentrated bid for chips, paid for in part by selling the safe, steady, incomey parts of the market. Healthy rallies tend to be broad. This one was a laser. And here's what makes it even stranger. The chips didn't rip in a friendly, falling rate environment. They ripped straight through a rising rate wall. Bond yields climbed, the dollar firmed, and the market now prices something like 85% odds of an interest rate hike in September.
Think about how unusual that is. Normally, the high-growth, long-duration names and chips are exactly that, hate rising rates. Today, they shrugged it off entirely. Yields up, dollar up, oil soft. That combination is a rate-hawkish risk on tape. Not reflation, not easy money. It's the market saying the AI capex story is powerful enough right now to climb a wall that would normally stop it cold. That's a strong signal, and a slightly nervous one, because walls tend to matter eventually. Now, the newest thread, and maybe the most interesting one, reports today that China cut its rare earth and critical mineral exports to Japan to essentially zero. Heavy rare earths all the way to nothing. Read widely as pressure over Japan's stance on Taiwan. And that squeezes Japan's semiconductor equipment, precision, and EV makers, who need those materials. Japan's Big Five equipment makers reportedly saw their first ever decline in China sales.
And this is a genuine evolution of the whole thesis. All year, we've traced the bottleneck moving up the chain, from chips to memory to the equipment that makes the memory. Now it's moving one layer deeper still, to the materials, the rare earths and critical minerals that the equipment itself depends on. The scarce input keeps receding upstream. Whoever controls the layer everyone else needs holds the leverage. And right now, in materials, that conversation runs straight through Beijing.
And to be careful with it, this is a fast-moving geopolitical story, so hold it as a developing signal, not a settled fact. But the direction is what's striking. A year ago, the scarce input everyone fretted about was the advanced chip itself. Then it became memory. Then the machines that make the memory. Now the conversation has moved to the raw materials feeding those machines. Each step upstream is a step toward whoever holds the least substitutable position. That's the lens we keep returning to. In a build-out this big, the real leverage sits with whoever supplies the one thing nobody else can quickly make.
And to see how serious governments are, look at Japan's response. It unveiled a 370 trillion yen plan. That's roughly $2.3 trillion over 14 years, with something like 600 billion earmarked for AI and semiconductors across 17 sectors. For a country famous for one-year budget cycles, committing to a 14-year industrial plan is a real structural break.
And Japan isn't alone. Korea's main index finished the half up around 101%. The best-performing major market in the world. Taiwan's up around 59. Japan's Nikkei up 37 in the quarter. This is a coordinated, government-backed, multi-year build-out across the entire chip-making world, which is exactly why the demand side of the AI story looks so structurally real, and why we keep saying this is about real demand and pricing power, not about anything getting cheaper. The macro backdrop was a genuine tug-of-war. On the strong side, job openings came in at 759,000, above expectations, the fifth straight beat. The labor market, on that measure, is simply not slowing.
But underneath, a crack. Consumer confidence missed, and the share of people saying jobs are hard to get hit its highest since early 2021. So openings stay strong, but how people feel about finding work is softening, and those two don't usually diverge for long. Add in a technical change to how one inflation gauge is composed, which mechanically nudges core inflation down a touch, but still leaves it above 3%. One bank cutting its recession odds from 25 to 15%. Oil down 21% in June, the yen at a 40-year low, and gold basically flat at 4,038. A lot of cross currents, all live at once. One earnings note, facts only. Nike reported its fiscal fourth quarter. Earnings came in at 20 cents a share, ahead of the 12 cents expected, and revenue of just under $11 billion also beat, though it was down about 1% year over year.
But the internals were soft. North America roughly flat, and China and the Europe, Middle East, Africa region on the weaker side. The stock slipped about 3% after hours, and there's a quiet structural angle. As one of the smaller weighted names in the price-weighted Dow, a persistent laggard can eventually raise questions about its seat in that index. We're not predicting that, just noting the internals were the story, not the headline beat. Let's give the bearish read its full due, because it's real. The single biggest risk here is that same narrowness. When an index makes a record on the backs of a handful of chips, while breadth is negative, it's more fragile than the headline suggests. If those few leaders wobble, there's not much underneath to catch the tape.
And there are two more yellow flags. The mega-cap group, the famous Magnificent Seven, actually fell something like 5 to 8% in the first half, even as the indices rose. That's money rotating out of the giant AI spenders and into the earners, the memory and equipment names actually booking the revenue. And on the speculative side, the money parked in leveraged single stock and index ETFs is nearing $200 billion, a classic sign of froth. When the leverage crowd gets that big, moves in both directions get amplified. Which leads to the honest, unresolved debate at the center of it all. Is the memory and semiconductor earnings cycle getting close to a peak? The kind of overbuild the industry has historically reached around, say, 2027? That's the real bear case. Not that the demand is fake, it plainly isn't, but that the market may be pricing today's boom as if it runs forever.
And the fair way to hold it is as a genuine tension, not a verdict. The demand is real, and the pricing power is real. That's not the same as saying anything is getting cheaper. It's the opposite. But real demand and priced perfectly for a cycle that never ends can both be true, and that gap is where the risk lies. We don't need to resolve it tonight. What we can say is narrower. The near term probably gets decided not by any of this, but by one number on Thursday. So let's do the net thesis read. On our first thesis, the AI value chain, today was a confirming day. The market is accruing value to the physical inputs, the memory, the equipment that makes it, and now, increasingly, the materials and rare earths underneath the equipment. Meanwhile, the hyperscaler spenders, the ones writing the CapEx checks, lagged. Value is flowing to the suppliers of the scarce thing, not the spenders, which is the spine of how we've been reading this all year.
The caveat rides right alongside it, though. That value is currently concentrated and a little frothy. A thesis being correct and a tape being narrow are not in conflict. Both are true today. The idea is validated. The market's expression of it is crowded. Holding both at once is the whole discipline. Two more thesis checks. On energy and power, our binding constraint thesis, the read stayed intact. A leading power equipment name hit a record, up more than 6%, and the nuclear names held firm. If AI needs power, the market keeps treating the pick and shovels of electricity as part of the same build. That leg is still standing.
And on gold, one to read carefully, because it's easy to get wrong. Gold pulled back slightly with the dollar firm. That is not a crisis signal. A firm dollar, higher yield pullback in gold is a rate-hawkish move. The market pricing that September hike, not a flight to safety story or a sign the thesis is breaking. The gold thesis is about long-run monetary and fiscal pressure. A rate-driven dip on a hawkish day is noise against that, not a refutation of it. Don't misread the wiggle for the trend. Which brings us to the week ahead, and it's a short, strange one. Markets are closed Friday for the July 4th holiday, so the jobs report got pulled forward to Thursday. Wednesday brings the ISM manufacturing read and, notably, a closely watched central bank voice speaking at the ECB's Sintra Forum, a real hawk or dove moment. And then Thursday, the June jobs report. In a holiday-thinned week, that print is the whole ballgame.
So here's where we land. The first half closed on a genuinely validated demand story. AI, memory, equipment, and now the materials beneath them, but expressed through a narrow, rate-hawkish, slightly frothy tape that climbed straight through a rate wall. Both halves of that are true. And the near term? It probably doesn't get settled by any grand thesis. It gets settled by Thursday's jobs number and whether the chip bid can absorb it. We don't predict, we test the theses as the evidence lands, one print at a time. Thanks for spending part of your day with us. We'll see you on the other side of the jobs report, and tell us in the comments where you think we're wrong.
Okay, that's our episode. The honest goal here is simple. Hold a few ideas about the world and keep checking whether they're still true.
Together, out loud, a little at a time. If you spot where we've got it wrong, please tell us. That's how this gets better. See you next time.